Welcome back to the deep dive. Today, we're doing something pretty specific. We've got the prepared remarks from a Q3 2025 earnings call, and our listener wants us focused just on the CFO section.
That's right. So no CEO talk, no Q&A this time, just unpacking what the chief financial officer laid out about the numbers, the strategy.
And crucially, how their AI models are still, driving the bus.
Exactly. The big story here really is this balancing act. They hit their profit goals, which is great, but they did it by deliberately tapping the brakes on loan volume.
Okay, let's unpack this. The overall vibe from the CFO was positive, right? Pleased was the word used, I think.
Yeah, please. Healthy growth year-on-year, quarter-on-quarter for revenue, and importantly, getting back towards consistent profitability.
But there's always a but.
But yeah, this came with a trade-off. Transaction volume wasn't quite where they wanted it to be.
Okay, so let's get into that core tension. Transaction revenue was, what was the phrase? Marginally short.
Marginally short of expectation.
Yeah. And the really fascinating bit here, for me at least, is why. It wasn't borrowers losing interest.
No, apparently not. Demand was still strong. The shortfall was completely internal. It was their AI, their own risk model being, as the CFO put it, temporarily conservative.
So the machine overruled the desire for more volume right now. Discipline.
Exactly. They listened to the model. It reflects their sort of core belief, get the credit performance right first. Prudence is the North Star, I think was the term used.
Right. So what specifically spooked the model? What signals did it react to?
Well, two main things they highlighted. First, their own internal measure, the UMI, saw a bit of a jump.
The UMI, Upstart Macro Index, right. What does that actually track?
It's basically their real-time gauge of economic stress relevant to their lending, and it ran up by almost 0.2 points during Q3. Doesn't sound like much, maybe.
But enough for the AI to say, hang on.
Yeah, enough to trigger a bit more caution, slightly lower approval rates, maybe bumping up rates for some borrowers. It had apparently subsided more recently, but the impact was felt in Q3.
Okay, and the second signal, you said there were two.
Right, the second one was rising repayment speeds, people paying back loans faster.
Which sounds like a good thing. Borrowers paying off debt faster.
It is good long-term, definitely. It suggests better credit quality overall. But, and this is the tricky part, it's a sort of dual signal.
How so?
Well, in the short term, if loans are paid off quicker, the lender actually earns less total interest over the life of that loan, right? Because the duration is shorter.
Ah, okay. Less interest income.
Exactly. So it limits the income from the current loans, and it means they need to charge higher initial rates, higher coupons on new loans just to hit the same overall return target. So the model has to tighten things up right away to compensate.
Got it. So conservatism now, driven by these signals, but there's a potential upside.
That's the idea. The CFO suggested that if these things, fast repayments, maybe slower consumer spending, really do point to improving credit health overall.
Then this period of holding back could actually position them really well.
Precisely. It could be that long-anticipated tailwind they mentioned, setting them up for better growth maybe heading into 2026.
Okay, so let's pivot to the actual results then. How did Q3 look on the P&L?
Pretty strong. Especially on the bottom line, total revenue landed at roughly $277 million.
Which is up.
Up 71% compared to last year and about 8% from Q2. So, solid growth.
And profitability was the real beat, wasn't it?
Yeah, much better than expected. GAAP net income came in positive, $32 million, and adjusted EBITDA was around $71 million, both, well ahead of what they guided for.
So how did they beat profit expectations if the core transaction revenue was slightly short?
That's where the revenue mix gets interesting. So revenue from fees, that's the main engine, right, from the transactions, was about $259 million. Good growth year on year, like 54%.
But that was the part that was short, by about 6%.
Exactly. That's the direct hit from the model's conservatism we talked about. Less volume, less fee revenue than hoped. Servicing revenue within that was steady, though, up 10% sequentially.
Okay, so if fees were a bit light, what plugged the gap to beat profit forecasts?
Net interest income, or NII. That came in much higher than expected, around $19 million.
And NII that's interest earned from loans they hold on their own books, right? Not the ones funded by partners.
Correct. It's from that pool of loans on their balance sheet, which remains, as they put it, temporarily elevated. Because those loans performed well, the NII generated was strong.
So that extra interest income basically acted as a buffer, offsetting the fee shortfall.
Pretty much, yeah. It counterbalanced it nicely. That's strong NII plus some good cost control.
Right, they mentioned reduced fixed costs.
Reduced fixed costs and also a one-time gain of about $7.2 million from repurchasing some convertible debt. Add those three together, the NII beat, cost savings, one-time gain, and that's how you get that positive $32 million net income.
Okay, let's talk volume dynamics. How many loans actually went through?
About 428,000 transactions in Q3, which is way up from last year, like 128% more, and up 15% from Q2. So volume was growing sequentially.
But the average loan size dropped.
It did, yeah. Down 12% from Q2 to about $6,670.
And that ties back to the AI's caution again.
Directly. The CFO pointed to a mix of factors. Borrowers asking for less, the model being cautious on bigger loans, and just a general mix shift towards smaller loan products and risk rates. Basically, selling smaller, arguably safer loans.
Makes sense. What about the efficiency of generating those loans? Contribution margin?
Contribution margin, non-GAAP, was 57%. Still healthy, but it was down about 1 percentage point from Q2.
Why the slight dip?
Primarily because those lower approval rates from the model's conservatism created some mild upward pressure on costs. Marketing costs per funded loan, onboarding costs. They had to work a little harder, spend a bit more to find and convert those approved borrowers.
But overall operating expenses were kept in check.
Yeah, GAAP operating expenses were about $253 million, roughly flat compared to Q2. And that was helped by cutting fixed expenses by 7%, mostly from things like compensation accruals. So good discipline there.
Okay, now, the elephant in the room, the balance sheet. How much are they holding now?
This is where it gets really interesting, yeah. They ended Q3 with approximately $1.2 billion worth of loans held directly on their balance sheet.
Wow. Okay, that's up from about $1 billion in Q2. For a company that wants to be a platform, a marketplace, that's a lot of loans to hold yourself.
It is. It's a huge number, and the CFO acknowledged it's larger than they'd like long term.
So what's the justification? Why hold so much?
The official line is R&D. These are primarily holdings for newer products. Think auto loans, home equity loans where they need to season the loans, prove the model's work using their own capital first.
Before they can convince third-party investors to step in and buy them.
Exactly. They need to build that track record. The strategy, they say, is to actively work on putting third-party capital deals in place for these newer areas to bring that balance down. They expect tangible outcomes by year-end and into 2026.
So that $1.2 billion is like a temporary, very expensive R&D lab on their balance sheet.
That's one way to look at it, yeah. Shows how aggressively they're pushing into new loan categories.
All right, let's look ahead. What's the outlook for Q4? They sounded kind of optimistic about the economy.
Yeah, they described the broader economic backdrop heading into Q4 as favorable.
Favorable based on what, though? Because some indicators are looking a bit mixed out there.
Well, here's where it gets counterintuitive again, especially for you listening. One key thing they pointed to was decelerating personal consumption growth. People spending less.
Wait, consumer spending less is seen as a good thing for credit health?
That's their read on it, yeah.
Yeah.
The thinking is it suggests households are maybe being more cautious, managing their existing debts better, not overextending themselves.
Okay. Less spending might mean less immediate economic boom, but maybe safer borrowers.
That seems to be the logic. Plus, the labor market's still strong. They see inflation effects from tariffs as muted, and the general monetary climate is gradually easing. So assuming things stay relatively stable.
They're shifting strategy a bit for Q4.
Yes. Because profitability is now sort of secured, the plan is to start dialing up our forward investment into customer lifetime value.
Meaning what exactly? Taking a bit more risk.
Not necessarily more credit risk, but more like strategic pricing risk. They plan to slightly moderate take rates.
So charge slightly lower fees on new loans.
Basically, yes.
Right.
Trade a little bit of upfront margin per loan in exchange for getting higher origination volumes overall, and importantly, encouraging more repeat business down the line, building that customer loyalty.
So they're confident enough in the model and the environment now to invest in growth by making loans slightly cheaper.
Seems like it. It signals confidence, right? They're willing to reinvest some of that Q3 profit beat into acquiring future volume and locking in customers.
And how does that translate into the actual Q4 guidance, the numbers?
Well, because of that decision to ease up on take rates and maybe some seasonality, they expect some metrics to moderate a bit from Q3's peak. Total revenue is guided to around $288 million.
Okay, and the mix, fees versus NII.
Fees are projected around $262 million. Net interest income, that NII from the balance sheet, is expected to peak in Q4 at about $26 million, before hopefully that balance sheet starts shrinking.
And contribution margin will dip because of the lower take rates.
Expected to dip slightly, yeah, to around 53%, and GAAP net income is forecast to moderate too, to about $17 million for Q4.
But the full year still looks profitable.
Oh yeah. Full year 2025, they're expecting total revenues around $1.035 billion, give or take, and GAAP net income for the whole year landing around $50 million. So ending the year in the black. Hashtag tag outro.
Okay, so wrapping this up, the CFO deep dive really paints a picture of a company that's very disciplined, almost beholden to its AI, willing to leave money on the table short term.
Yeah. Sacrifice that immediate transaction revenue.
To ensure the long-term credit quality is sound and hit those profitability targets.
Absolutely. And for you, the listener, the key thing is seeing how that AI translates these broader kind of fuzzy macro signals like the UMI index ticking up or repayment speeds changing into very specific concrete underwriting decisions. That's the mechanism.
That translation is critical. Understanding why they accepted lower fees because the model said, be prudent. That's the real insight beyond just the top line numbers.
Yeah, exactly.
And maybe we leave you with that really provocative thought from the CFO again. Decelerating personal consumption growth, seen as a signal of improving credit health. Why would consumers tightening their belts be considered a positive sign for lenders? What does that tell us about maybe the underlying fragility or resilience of consumer finances as we look towards 2026? Something to think about.